This video is sponsored by the programs on building your wealth, linked down below, and the experience to shadow me if you'd like to do that in person. Check out all of that, linked down below. You get lifetime access to all of the content, the course member live streams, and new information that's regularly added. So what's Wall Street saying about the Federal Reserve minutes? And what says Kevin about the Federal Reserve minutes? Because in my opinion, there were two massive things that we had to pay attention to. One of which I'm actually going to play you something that Jerome Powell said in May of 2022. Nobody wanted to hear this in May of 22. Nobody. But when Jerome Powell said it, it was so salient to me that I've been pounding the table about this, and it got reiterated in the minutes today. This is absolutely remarkable, so we'll have to touch on that. But first, why don't we just go ahead and hit what some of Wall Street is saying. First, we'll look at Nick T, the Fed's mouthpiece, and then, of course, we'll jump on over to a Morgan Stanley piece talking about the minutes and some of their thoughts on the minutes. So first, what does Nick T tell us? Well, he, of course, hits on one of the two most salient pieces, but he only hits on one of the two most salient pieces. So I'll give you part one now, and part two, stand by. So part one, he reiterates, much like what it was immediately picked up on, this idea that a few members wanted to raise 50 BP. Now, I want to make this very, very clear. Nothing has changed here. Bullard's been talking about front-end loading hikes, rate hikes forever. Since this rate hiking cycle started at the beginning of 2022, he's been talking about, let's just go 100 basis points, let's get to 4, let's get to our terminal rate, whatever that may be, as soon as possible. And there's this expectation now that, somehow, because now all of a sudden the minutes are reflecting that some members over at the Fed are like, let's go 50, there's this idea that, maybe markets are going to start pricing in 50. In my opinion, it's complete nonsense. It doesn't make sense to go 50, and I'll tell you exactly why. First of all, let's lay out the schedule here, okay? The difference of going 50 here in March is really to speed things up by about 5 weeks. That's what you're trying to do. You're trying to take the June 25 BP hike and basically move it up to March, to speed it up before you get to your May meeting by about 5 weeks. The problem with that is by taking a 5-week advantage. So in other words, if you're gonna bet on March 22nd, write that one down, okay? March 22nd is the next Fed meeting. If you're gonna make a trade on the March 22nd meeting, my opinion is you're going to have a lot of fear going in of people going, that's it, they're gonna rug pull us, they're gonna go with a 50. All that buys the Fed is a 5-week advantage. While at the same time they get that 5-week advantage, they would turn around and you know what they would do? They would absolutely kill their credibility, whatever they have left, right? Because now they, much like me, would become certified flip-floppers. And it would show, we really are starting to sound like the 1970s. Think about that for a moment. All of this is about psychology at the Federal Reserve. When bad data comes out, the Federal Reserve has already trained us to tighten financial conditions. When we got a tight jobs report, inflation report, PPI report, and tomorrow we have the PCE report, guess what markets immediately did? Markets immediately tightened financial conditions. In other words, Treasury yields rose. We're at the highest level on Treasury yields right now since November. We're sitting at 3.94%. Yesterday, I was looking at some real estate actually down at Chula Vista, and the agents that were telling me a week or two ago, it feels like things are bottoming. Things are turning around in real estate. And I'm like, no, I don't think so. You guys are getting head faked because interest rates just popped up again, and it's just going to take another couple weeks before it shows up in the real estate market. Guess what a real estate agent starts telling me yesterday? Yeah, a few weeks ago, we were selling stuff again with multiple offers, but now I feel like we're right back in the doldrums. People aren't showing up again. It's like quiet again. I'm like, yeah, because rates just skyrocketed. Like, it's not brain surgery. It's actually quite simple. But anyway, here's the problem. In the 1970s, we went into the 1970s with excessive price caps, ceilings on things like certain food items, gas, oil. These things led to massive shortages for gas. Everybody knows about the 1970s gas shortages. It's crazy. A lot of these price or shortages of goods and services were created because of price ceilings, caps. Anytime you put a price cap on something, you artificially keep the price low. But what you do is you create deadweight losses. It's kind of like rent control. When you put a cap on rent, you temporarily make people feel better, but you actually substantially damage the future market and you make things more unaffordable. You actually create more housing inflation with rent control. 90+% of economists agree with exactly what I just said. Now, here's the problem, and this is what happened in the 70s. We removed the price caps. So what happens when you remove the price caps? Prices frickin' skyrocket, right? But guess what happened at the same time in about 73? We left the gold standard. So at the same time as we removed price caps, we left the gold standard, and all of a sudden, oh my gosh, look at all this inflation. The inflation was being caused by having left or removed the price caps. But it happened at the same time as, oh no, we just left the gold standard. So the psychological impression was, oh no, this fiat experiment is a disaster. We're going to have so much inflation. It broke inflation expectations. It killed the psychology of markets. This is why I have a course on the psychology of money and the Zero to Millionaire Real Estate Investing course when it talks about in negotiating with real estate agents, or what we talk about in the stocks course. A lot of it is based on psychology, human psychology. Markets are graphs, essentially, of human emotion, after all. Anyway, so now all of a sudden you have this impression in the 1970s that, oh my gosh, we left the gold standard. That's obviously why we have all this inflation. And what was the Fed doing? The Fed was constantly flip-flopping. They're like, okay, we'll raise rates a little. Oh, it looks like things are getting better. Okay, we'll reduce rates a little. Oh no, okay, things are getting bad again. Okay, we'll raise rates again. That flip-floppiness led to a disaster. It led to Paul Volcker. That flip-floppiness, no pants on, no seriousness, no might, led to Paul Volcker. Now, a lot of conditions created that leading up to it. Obviously, the gas shortages, the removal of the price caps, at the same time as the breaking of inflation expectations via post leaving the gold standards, right? All of that contributed to Paul Volcker. The problem is the Fed does not want to repeat the disaster of what came right before Paul Volcker, which is flip-flopping. They do not want to appear to be flip-floppers. I think that in their ideal world, they still want to tell you inflation is transitory. So anyway, to get a 5-week advantage, to become certified flip-floppers, it makes zero sense at all. Like, things are not all of a sudden that bad that the Fed needs to essentially try to rug pull markets. It makes zero logical sense at all. So I do not see that happening at all. And hey, maybe I'll be wrong, but I think the odds of me being wrong on this one are 1%. I think it's very, very, very low. I'm pretty confident in this. Of course, you've got Mr. Bullard and Mester saying things like, hey, I don't see much merit in delaying our approach to that level. Honestly, at this point, I guarantee you the other members of the Federal Reserve Board are like, oh, Bullard, say something else, man. You've been saying that for 18 months. I could see Bullard at the meeting. Guys, we need to front end load it. And everybody else is like, all right, got anything else to contribute? Because that's the same thing you said every one of the last 14 meetings. Whatever. Anyway, and then of course you have the counter argument, which I think is a fair counter argument, which is this one here, Tom Barkin saying something like this. That theory to me requires more confidence in understanding the effectiveness of a tighter rate policy than I currently have. Now that's actually really important because we do not, two schools of thought in economies, and we were talking about this actually with the team right after we came back from San Diego yesterday, looking at real estate for House Hack. We had a spa office meeting. It was great, and we were talking about the two different trains of thoughts: Austrian School of Economics, Keynesian. Anyway, one of the important characteristics here is that maybe inflation is not solely dictated by rates. After all, we had 40 years of declining interest rates and no inflation. Maybe instead, oh my gosh, imagine this. Inflation is caused by the rapid or sudden acceleration in the expansion of the money supply. Now, that's not to be confused with, okay, if you print money, you create inflation. We've been printing money for 40 years. But we'd never printed money at the scale we did during the pandemic, and that is not a Keynesian belief, right? That is sort of just a belief of usually you look at interest rates. Anyway, the point here is Tom Barkin is basically telling us, look, we don't know that front-ending rates is actually going to make a difference. So we're going to stick with 25 BP. We also don't know what the lag is. Is the lag 3 months? Is it 6 months? Oh, the Fed's communication is better? Or is it old school, Milton Friedman, 18 months before the Federal Reserve's rates are actually truly felt by everyone, right? So, in other words, that's sort of my rant about part one of these minutes. And then, of course, they make arguments here like hiring, surged, inflation surged, some bad numbers in January. Okay, we get that. Some of that could be seasonal or it could be real. We just don't know the answer to that yet. That's redundant at this point. We do know, I wrote this here, that the terminal rate as of just about 20 minutes ago when I wrote it down was about 5.37. That's obviously up from where we sat as a terminal rate projection from markets of about 4.9. Now, some say that this rate could end up going up to 6%. Personally, I don't know that the market's going to care that terribly. I think the market cares more, not so much about this terminal rate. I think the market cares more about the potential of a Paul Volcker having to come out because the Fed doesn't know what the F it's doing. And so I think the last thing the Fed wants to signal is they don't know what the hell they're doing. So that's why, again, I'm reiterating this 25 BP here. Now, I want to get to the second part that's really important. But first, before I do that, let me just show you what Morgan Stanley said. So their takeaway on the FOMC minutes was that they were relatively and fairly balanced. They mentioned over here that almost all participants supported the 25 BP, right? They're picking up on part one as well. Now, this is where on the left side, I was sort of, as I was reading the notes, I wrote, look, saving 1 month of time basically is not worth the credibility hit that'll happen. Basically what I just explained. But now this was really interesting because this is something that I've been talking about. I picked up on immediately when Jerome Powell mentioned this. I studied Jerome Powell very well. And when Jerome Powell responded to Dave Rubin about, hey, like this jobs report just came in hot, like what say you? Jerome Powell immediately quipped back and basically said, well, financial conditions have already tightened and, one report doesn't make a trend. And like this is basically the Fed saying, look, let the market respond to the data. We've been very clear that hot data means things have to get tighter. Good data means things can maybe get looser. And so the Fed's kind of like, market's doing its job already. And that's fantastic because even though we've had a couple red days here, maybe coming up on maybe about a week of red, we're still obviously well off the lows where we've been. And I think now that this sort of catalyst of the Fed minutes is behind us, markets are kind of like, okay, like should we kind of start going back on that uptrend of the Fibonacci retracements, right? So, and that's because markets are looking going, okay, well, maybe it's just not that bad. Like, okay, so slightly higher rates for slightly longer. Okay, great. The stock market doesn't care about that. The stock market, in my opinion, cares about getting Paul Volckered. The stock market doesn't care about a slightly higher for longer terminal rate. But you know who does care about a slightly higher and for longer terminal rate? Real estate. And this is where everybody seems blind to what Jerome Powell is actually trying to do. And I'm going to play you this for my TikTok. Because I played this like a long time ago. I get so excited with the Fed. Anyway, let's see here. Let me make sure we got the volume over here. Let's go ahead and pick this. I don't want to blow anyone's ears up here. Is it this one? I just want to get the audio going here.
Just warned us that home prices might be coming down. And even though he's not certain, he just gave the biggest warning I've
I'm just going to fast forward a bit.
Somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together and where inflation is down low again and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place and housing availability and credit availability are at appropriate levels.
Holy
Yeah, so I mean, internalize that for a moment. Think about what you just heard. If you're a home buyer, wait for a reset. We need the housing market to settle in a new place. Why would Jerome Powell say we need the housing market to settle in a new place? Because have you heard of the wealth effect? The wealth effect is when your wealth goes down, you spend less money, right? Not so fast. It's not actually your stock wealth that matters that makes you spend less money. Because maybe we've already adopted some of the psychology of money of hey, you know what? In the long term, things tend to work out. That's fantastic. But it's actually real estate that reduces spending via the wealth effect. Robert Shiller from Princeton, famous economist, came up with the Case-Shiller Index for real estate. Real estate is what kills spending. When real estate goes down, people spend less money. Why do you think Home Depot's like, oh yes, it appears people are going to start spending less money? Because real estate prices are going down. We've been talking about this on the channel for a year, that real estate related companies are just going to keep suffering and suffering and suffering. And your big barometer of this is the 10-year treasury yield, which the 10-year treasury yield, it ain't going down. In fact, it keeps going up. So in a weird way, look at this. The 10-year treasury hits a high from November. And what's the pre-market? Oh, look, all the stocks are red. NASDAQ's up all the stock indices are green. You've got the Dow up a third. You've got the S&P 500 up 0.5%. NASDAQ's up 1%. You've got oil green here. It doesn't matter so much in the sake of this. We're just going to focus on bonds and stocks here. But point is, you can have a rising stock market and rising yields. And then people get this crazy thought in their head, but wait a minute, Kevin, I was told by the basic finance stuff that when yields rise, stocks become less desirable. And you go congratulations, you've made it to Finance 101. Now let's teach you the big boy stuff. And the big boy stuff says, as long as we're not getting Paul Volckered, your opportunity cost of not being in stocks is substantially higher than the stupid 4 or 5% you're getting on the treasuries right now. That's why you could actually see yields rise and stocks rise, because the Fed doesn't care so much about the stock market. The Fed cares more about the real estate market. Now, let me prove that to you by actually showing you what they said yesterday. And this is the big part too. Look at this box right here. This is a phenomenal box. Just listen to this one. All right, here we go. Oh God, just hold on. My stupid iPad is being stupid, so stand by. Let's refresh that really quick, and then I get this for you. Okay, yeah, there we go. Now you can see it better. Oh, gosh, I just get so excited about this stuff. I'm sorry. I apologize. Maybe it's the 5 coffees I've already had. It's 5 a.m. The staff provided an update on its assessment of the stability of the financial system and, on balance, characterized financial vulnerabilities of the U.S. financial system as moderate. Good. Okay, so we're not breaking shit yet. Fantastic. The staff judged that asset valuation pressures remained notable. Okay, that's not great, right? Because if asset values are high, the wealth effect is in essentially a great place where people can feel like they're still spending lots of money because they haven't. In particular, the staff noted that measures of valuations in both residential and commercial property remained high, and that the potential for large declines in property prices remained greater than usual. Prices are already down 10 to 20% in various different, nationwide, real estate prices are already 10% off peak. In certain markets, you look at Austin, Texas, Vegas, Phoenix, Boise, you're down 20% already. In addition, the forward PE ratio for S&P 500 firms remained above its median value despite the decline in equity prices over the past year, above its median value, okay, right? The staff assessed that valuation pressure had eased for corporate bonds and leveraged loans as spreads in markets had increased from recent lows. Okay, fine, great, fantastic. So maybe bonds are being priced appropriately, but I want you to focus for a moment on what they said about stocks versus real estate. For real estate, they said large potential for large declines, right? I'm literally going to use their words here, potential for large declines. What else did they say? They said valuations remained high, right? Valuations remained high. Those are their words, not mine. What did they say about stocks, specifically the SPY, the S&P 500, which has a lot more consumer staples in it, which haven't really had as much of the stock declines as tech or growth, right? They didn't mention the NASDAQ. They mentioned the S&P 500, okay? Well, what they said for the S&P 500 was above median. So valuations for the SPY are above median trend. Okay, so which one seems more scary? Potential for large decline, valuations remained high, or above median? The Fed is sending a huge signal here that it's not stocks that are still in a horrible place, although there's a risk that those companies exposed to more of that consumer staples sort of safety idea like your McDonald's are going to get effed because they're going to have higher, and even the companies like Walmart, because you're going to have higher labor costs, higher food costs, but they're not going to have PP. They're not going to have the pricing power to be able to pass on those extra costs. Read the Tyson Foods earnings call and you could see exactly that. Read Energizer, read the earnings calls for these companies, you'll see that, or I'll just give you the bottom line. But anyway, those are companies that are probably still going to get hit. So sure, the SPY could still move towards median, although I think a rising tide lifts all ship. The big red flag here was for real estate. So if you really want to know what was said in those minutes yesterday, let's make it super simple for you. Check out the flash sale on the programs on Building Your Wealth down below and researching stuff the way I do. But also join me in those course member live streams every day because it's included in any of the courses you buy, and in the Elite Hustler course, you get an exclusive Saturday live stream focused on business. So when we do financial analysis during the week, on the weekend, on Saturdays, we do business analysis, and it's great. It's really fun. So check that out. I'm always adding to these programs as well, so I don't think they get dated at all. And if there's ever anything that's missing, people send me an email or let me know in the live streams, and then I add it. It's a beautiful thing, is you get lifetime access. So check that out, link down below. But that, folks, is my summary on the FOMC minutes, and that is very, very important. Now, somebody here says, Kevin, way too bullish. I'm sorry. Well, look, I've talked about the bear case many times on the channel. I go through the bear case all the time, and I don't actually think I'm bullish. I'm actually providing you where I am bearish. I'm being very, very crystal clear here. I'm highly bearish on real estate. I'm highly bearish on the SPY. I'm highly bearish on staples. I'm highly bearish on oil. People are like, oh, Kevin, you're just a bull. I'm like, are you hello, are you missing something? Like, how many times have I been bagging on specific certain sectors that I think are going to perform poorly? Doesn't mean I'm going to be right, but I'm being very, very clear. Bearish on things I just mentioned. I won't reiterate it. But I'm also very bullish on the things that have been sold off because I think they're freaking phenomenal value opportunities. High free cash flow, decade-long pricing power plays, chips, energy, EVs, autonomy, robotics. But I don't want money-losing companies because, yeah, we might go through a recession. So I'm insulating myself with what? High free cash flow. I mean, I think I'm pretty clear, man. I think I'm pretty damn clear. Anyway, I'll leave it at that. But, God, I don't know. It's entertaining.